When Delta Airlines posts a $289 million GAAP net loss, calculated according to generally accepted accounting principles, it's easy to dismiss it. You might feel that familiar pang of disappointment. Mainstream reports often suggest core weakness, but this is precisely where the surface narrative misleads and true fundamental analysis begins. What if this loss is a carefully constructed illusion, masking a powerful investing strategy? The true twist lies in the $712 million divergence between that GAAP loss and Delta's impressive $423 million adjusted net income. This isn't just a rounding error, it's primarily a hefty $550 million mark-to-market non-operating loss on equity investments. Mark-to-market means if investments drop in value, accounting rules require a paper loss, even if unsold. Adjusted metrics strip away such non-core volatility, revealing operational performance. But here's a crucial investor's lesson. Recurring investment losses force scrutiny. Do they reflect core operations or mask unpredictable exposure? Always differentiate between day-to-day business and external financial noise. To understand Delta's resilience and apply solid value investing principles, we must shift our gaze from the profit and loss statement to the statement of cash flows. This document shows exactly where cash is coming from and going. Is robust cash generation the real barometer of Delta's health? Despite the GAAP net loss, Delta generated an astounding $2.43 billion in operating cash flow. This powerfully validates its core airline business. This cash was largely fueled by a colossal $3.58 billion increase in advanced ticket sales, demonstrating immense customer demand. This provides $8.1 billion in ample liquidity to fund crucial capital expenditures and reduce debt. Relying on just one metric like GAAP net income is dangerous. Cash flow reveals the true engine room. Once you grasp this distinction, you'll see financial reports in a new light. Now, the premium paradox. Can soaring premium demand insulate against broader cost pressures? Delta's premium products revenue surged 14% to $5.36 billion. Diverse revenue streams like maintenance, repair, and overhaul services and loyalty programs now account for 62% of adjusted revenue. This high-yield strategy clearly works, reflecting strong demand. Yet this top-line strength is overshadowed by net loss and rising input costs. What does this mean for your portfolio? Even a robust revenue strategy isn't immune to economic headwinds without disciplined cost management. This brings us to the fuel price time bomb. Management warned of a staggering greater than $2 billion increase in fuel expenses for the second quarter of 2026 based on forward curves. This material threat will pressure operating margins already guided modestly at 6% to 8%. Navigating this cost challenge requires exceptional operational efficiency and pricing power. Identifying critical input costs and their projected shifts is vital for sound stock market analysis. It tests Delta's business model resilience. But fuel isn't the only cost story. Non-fuel unit costs, specifically cost per available seat mile, excluding fuel, rose 6% year over year, with similar growth expected in the second quarter. This persistent inflation, driven by higher crew costs and strategic capacity reductions, represents a continuous drag on margin expansion. Managing these sticky costs effectively, particularly in a strong labor market, is critical for profitability. The investor's lesson here: even successful top-line growth can be eroded by uncontrolled operational expenses. This is something you can easily check. Amidst these challenges, Delta strengthened its balance sheet, reducing adjusted net debt by $760 million in the quarter, bringing it below 2019 levels. This deleveraging effort strengthens financial health, reducing future interest burdens. This clear commitment to stability persists even as shareholders' equity declines slightly due to net loss. Shrewd management prioritizes long-term financial structure over short-term accounting optics. Finally, the corporate travel comeback is a golden opportunity. Corporate sales grew double digits year over year, with 85% of corporate clients expecting to maintain or increase travel spend in the second quarter. This strong rebound in high-yield business travel is a significant tailwind. The challenge lies in sustaining this momentum and ensuring it translates into robust operating profits. The Monroe refinery, expected to provide a $300 million benefit in the second quarter, further illustrates Delta's unique fuel hedging strategy. So, how can a company report a $289 million net loss and still signal record strength? The answer lies in masterful core business execution, generating $2.43 billion in operating cash flow and strategically growing high-yield segments despite non-operating charges. Their commitment to financial discipline through debt reduction, alongside smart investments in premium experiences, positions them uniquely. That's why I believe Delta Airlines, despite the looming greater than $2 billion fuel expense hike, will not only meet but potentially exceed its second quarter operating margin guidance of 6% to 8%, proving the profound disconnect between reported losses and real financial strength. But I want to hear your take. Does Delta's strong cash flow outweigh its accounting losses for your investing strategy, or do the rising costs present too great a risk? Let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.